Today, we're going to pull on this one single thread that, believe it or not, connects the perfect spiral of a sunflower seed all the way to the chaotic ups and downs of a stock chart.
You know, when you look at the financial markets, it just feels like pure chaos, right? It's this storm of news and emotion and prices flying all over the place. But what if I told you that hiding underneath all that noise, there's a kind of hidden rhythm, a structural pulse that just repeats itself over and over again?
And that rhythm? Well, that's what we're calling the golden thread. It's a universal math principle that pretty much governs how things grow and behave, and it doesn't matter if it's a living thing or the shared psychology of millions of traders. So how does this one idea tie it all together? Well, let's follow this thread back to where it all started.
Okay, so our story actually kicks off way back in the year 1202. There was this mathematician, Leonardo of Pisa. You probably know him better as Fibonacci, and he's the one who first documented this hidden order, this sequence of numbers that, as it turns out, basically describes the architecture of growth itself. Now, this is not just some random string of numbers. You've got to think of the Fibonacci sequence as a kind of framework for understanding organic growth. It describes any system that expands in perfect proportion to its own history. And what that creates are structures that are not only super efficient, but also incredibly strong. So how does this blueprint for natural growth actually work? The amazing thing is, it's so simple, but at the same time, it's infinitely powerful. Let's just break it down real quick.
You literally start with 0 and 1. That's it. Then you just add the last two numbers together to get the next one in line. So 1 plus 1 gets you 2. Then 1 plus 2 is 3. 2 plus 3 is 5, and you can just keep doing that forever. This super simple progression is basically nature's own counting system, and it makes sure that growth is always perfectly scaled.
But here's the thing. The real magic isn't actually in the numbers themselves. No, it's in the relationship between them. See, as the sequence gets bigger and bigger, if you take any number and divide it by the next one in the series, the answer gets closer and closer and closer to one single constant number. All right, this is where it all connects. This is where we bridge that gap. We're about to see how that constant ratio, nature's blueprint, shows up absolutely everywhere around us. And then we're going to translate it into the exact percentages that traders use to analyze financial charts.
Seriously, this mathematical fingerprint is everywhere. It's in the spiral of sunflower seeds, which packs them in the most efficient way possible. It's in the beautiful curve of a nautilus shell, which lets it grow bigger without ever changing its basic shape. It's even in the proportions of our own DNA. Nature uses these ratios over and over to solve problems of efficiency and optimization.
So how do we get from this sequence of numbers to percentages we can actually use? It's just simple division. If you divide a number by the next one, you get 61.8%. If you skip a number and divide, you get 38.2%. And what if you divide a number by the one before it? Well, then you get 161.8%. This is the alchemy, right here, that turns nature's code into a trader's toolkit.
And this is the big one, 61.8%, the golden ratio. In the world of trading, this is often seen as the most significant, the most critical structural level for support or resistance when a price is pulling back.
And here we have its inverse, the golden extension. So while that 61.8 level helps us figure out where a pullback might stop and turn around, the 161.8 level is used to project where a trend might be going next. Think of it like a target.
Okay, so we've got our percentages. Now, let's actually see how they're applied. We're shifting gears from the why to the how, and we're going to look at the tools traders use, not as a crystal ball, but more like a map for understanding the market's psychological landscape.
These are the heavy hitters, the key retracement levels you'll see on almost any chart. The 38.2% level, that's often a quick, shallow bounce in a really strong trend. The 61.8, that's the critical structural level we just talked about. And hey, notice the 50% level? Now that's not actually a true Fibonacci number, but it's such a vital psychological midpoint where buyers and sellers often just agree on a price.
And believe me, it gets even more advanced from here. See, the pros don't just look at price. They look at time and angle too. You have Fibonacci arcs, which create these dynamic, curved barriers. You've got fans that measure a trend's momentum. And then you have time zones, which actually try to predict when a big reversal might happen, not just at what price. Okay, now we've reached the most important part of this whole thing. Because a single Fibonacci level is, well, it's just a line on a chart. It's totally meaningless by itself. The real secret to making any of this work is a concept called confluence.
So what is Confluence? It's when several different completely unrelated tools all point to the exact same price area. It's kind of like having multiple witnesses all telling the exact same story. When that happens, when things line up, you get a high probability decision zone where some kind of market reaction is way more likely to happen.
So here's what that actually looks like. A smart trader isn't just staring at that 61.8% line. No, they're asking questions. Does it also line up with a major moving average, like the 200-day? Does it sit right on top of a previous peak or valley? Basically, are there multiple reasons to believe this specific level matters more than any other?
And when it comes down to it, this is why it works. Is it some kind of magic? No, not at all. It's psychology. It's a self-fulfilling prophecy. Because millions of traders and their trading algorithms all know about these levels, they all place their buy and sell orders right there. And that giant cluster of orders is what turns a simple mathematical ratio into a powerful real-world barrier on the chart.
All right, let's wrap this all up with a clear, disciplined strategy. You have to remember, Fibonacci is a map. It shows you potential areas of interest. It is absolutely not a crystal ball that predicts the future.
This right here, this is the essential professional mindset. The market can and it absolutely will do whatever it wants to do. These tools aren't for predicting. They're for analyzing probabilities and, this is the most important part, for managing your risk.
So here's a professional framework for you. Step 1. Always check the bigger, higher time frame trend. Step 2. Find a clear, strong price move that's easy to measure. Step 3. Hunt for that all-important confluence. And finally, Step 4. Wait. Wait for the market to actually prove you right with confirming price action before you ever risk a single dollar.
So there you have it. The golden thread is real. It connects the mathematical perfection of the natural world to the messy psychological battlefield of the financial markets. The patterns are right there for anyone to see. But the real question is, will you have the discipline to actually follow that thread wisely?